深深的一个凝视。
Have looked now in detail to the differences between the way that banks operate risk transformation and the way they do the insurers. So, risk transformation by banks. First, core business risks are concentrated on the asset side. I told you several times. Which is the business risk of banks? Business risk of banks is credit risk. And that's concentrated on the asset side. Why? Because the borrowers are on the asset side. Well, let's say on the asset side. It means that they correspond to the credits, to the loans, to the main activity of the bank, to the mission. And the mission of the bank is making loans. Okay? Core business risks are concentrated on the asset side. Then the banks have experience, technologies, and competence for professional management of assets. Look, experience, technologies, and competence. So they are three different things. But I emphasize technology and competence. Of course. Experience is very important as well. Of course. But technologies and competence are very important in case of bank. Maybe more important, relatively. Now we see. We'll see why when we compare with insurers. They have know-how, in other words. They have know-how. They know how to do that. Then they are able to perform packaging. What is this packaging? This packaging is the capability to make something at what? Change risk characteristics of loans to let matching of borrowers and depositors. Because I told you at the beginning, a few days ago, I told you, well, when you bring your money to the bank, well, you can take off the day after. Of course. That's not a bond that you have to wait for the expiring debt. You just go there the day after, you take your money. But that money is being given to the enterprises for a medium to long term. So it seems quite strange that the banks are capable to manage. Well, the reason is a probabilistic reason. Because the probability that all depositors will claim back deposits immediately is very low. It's very low. So it will be sufficient to keep a quota share of these deposits as a guarantee, as liquidity to be given back to the small portion of depositors claim back their money soon. All the remaining portion can be given to the borrowers. That's matter of probability once again. They are able to diversify. You see, I explained to you this difference between risk subdividing and risk hedging. That comes from Diamond about delegated monitoring, the famous article. And you remember the difference that subdividing and having. Risk subdividing is the kind of diversification we are used to think about when we deal with financial items. But if we speak about insurance, the diversification, we operate by collecting risks in the same pool. In fact, we call that pooling. That will be diversification by having in the same pool, same kind of risks. And same kind of risks means homogeneous, but homogeneous, but uncorrelated, so that we can say that that's investigation. Well, they enjoy reducing incidents or information costs since they manage portfolios instead of individual loans. Yes, of course, because to make loans, you need to raise information about the enterprises to whom you are granting this money, right? And that's a costly activity, of course. You need to pay somebody to go through the balance sheets and you need to go there, you need to offset the management for a period, you need to do a series of things, and all of them are costly. So the banks can do that, sharing this cost on a great intermediation margin, a great amount of money flows through the bank itself. Differently from just one investor. Let's imagine that I have to lend my money, that I have to buy bonds from an enterprise. So should I pay a lot of money to raise information about that enterprise, or just I just have to trust what newspapers say about that? No chance. A bank could charge this information cost efficiently. They have the capability to face as many information. That's crucial. That's crucial. There is a great literature about that, covering about 20, 25 years, about capability of banks to manage as many information. As many information, I told you yesterday, between bank itself, the bank, and borrowers. And the enterprise taking money, because you lend them money, but you can't be sure what they do with that money. Of course, the way that they use that money. So that all these results in risk lowering activity. All these activities, the result of all of these activities is a risk lowering. And in fact, we are speaking about risk transformation. And risk transformation here means risk lowering. Now, let's have a look at the insurers in the same way, with the same items. Insurers. Well, core business risks are concentrated on liability side. Differently. You see, I told you several times yesterday, today, this is the third time today. So keep in mind. Again, core business risk. They have experience, technologies, and competence. Now, they are the same three words. But now I emphasize just the first. Why? Because experience is much more important in case of insurance companies. The experience, that's much more experience. Everything is much more experience in the field of insurance. Everything depends on probability. And probability, well, what is probability? Probability is that's matter of experience. So that we call the way that insurers price their contracts experience rating. Experience rating. The way that insurers price the contracts is called experience rating. That's all by shows. So they have experience, technologies, and competence for professional management of subscribed risks. They are able, in fact, to perform experience rating. They are capable to price on an hourly basis. So they don't price looking at the, cost of raw materials, general expenses, and so on and so on. They have to price looking at what? At the probability that something will happen. So on an hourly basis, and that's a peculiarity of insurers. Well, it's not exactly like this, but at first sight, they are the only financial intermediaries doing that. Also, they also do that. Banks also do that. That's another story. We will speak about that later. They are able to diversify, but now we speak about risk heavy, because we are thinking about pooling here, the pooling. Also, again, you have reduced incidence of information costs because they manage portfolios. Now, portfolios of risks, of pure risks, instead of loss or cost. And they have the capability to trace the estimated information. Now, nothing changed apart from making this estimated information being on the liability side, because this is the estimated information with the customers, and customers of insurance companies are on liability side. The prototypical customers of insurance companies are on liability side. What do I mean? I mean that they are the policy holders. So people giving money to the insurers, and if they give money to insurers, well, it means that they are in some sense creditors, because the insurer is going to promise something. That will not be granted for sure, just if something happened. But anyway, that's an aleatory credit, again, aleatory. All these differently from what we saw looking at banks differently. It's not the least risk, it's nothing. Do not result in a risk lowering, but in a risk redistribution. And we should say better, not a risk redistribution, but a redistribution of the bad outcomes of risk. I mean the losses. Because the losses, $90,000 losses, will be redistributed. So that's a matter of how lost money is paid. The money lost by just 3 people is paid by 1,000 people. That's different. That's not a matter of redistribution of risk properly, but redistribution of the bad outcome of risk. That's say the loss.